Hello, everyone, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Unrelated Business Income Tax, What You Need to Know. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters from Moss Adams, Patty Mayer, Director, and Colleen Ramires, Senior Manager. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Patty to get the presentation started.
Okay, thank you, Amy. So today's topics, we're going to go over a definition of unrelated business income, exceptions and exclusions, and reporting. I'm going to cover those 3, and then Colleen is going to pick up for debt-financed income and separate reporting. So starting with the definition. If we look at an overview of unrelated business income, this was added into the Internal Revenue Code in 1950, and the purpose of this was to eliminate unfair competition with for-profit businesses. So unrelated business income, how it's taxed depends upon how your foundation is formed. Your private foundation could be formed as a trust or a corporation. So you would look at the rates. If you're a corporation, corporation rates. Trust, you'd look at trust rates. And this is basically income that does not further the exempt purpose of your organization. When we think about a private foundation, some of the most common types of unrelated business income that you'll see relate to your alternative investments. So if you have a partnership investment or a LLC investment, that entity is going to pass through their activity to you on a K-1. And what typically generates unrelated trade or business income from this K-1 will be if they have ordinary income or losses. It may not be related to your exempt purpose, so that would be taxable. And then debt-financed income. And Colleen's going to be going over debt-financed income, but at the partnership level, they could have taken out debt to invest in something that's generating dividends, interest, capital gains. So things that normally would be excluded from UBIT are now taxable because they're debt financed. When we look at a definition, this is a general definition for unrelated trade or business income, and it focuses at an activity. So let's talk about an activity first real quickly. So if you're a private foundation and you're in a partnership and they pass through ordinary income, is that activity related to your exempt purpose or not? You want to look at all the angles because maybe it's not unrelated business income, although in most cases it probably is. If you're a private foundation or private operating foundation and you are a grant-making organization, but you also conduct programmatic activities. So in the programmatic activity area, you want to evaluate your revenue streams to see if anything could rise to the level of an unrelated business activity. So when we look at the three rules, if you meet all of three of these rules, you do have an unrelated business income. And that would be the activity rises to the level of a trade or business, it's regularly carried on, and it's unrelated to the exempt purpose. Now, if you fail one of these tests, then it's not going to be unrelated business income. And also, you focus on the source of the income, not that it's going to be used for a charitable purpose. It's how is it generated. And if we think back on how unrelated business income was enacted, before 1950, Congress met and they had hearings, and there was a lot of uproar from the for-profit business sector because there was unfair competition. If a nonprofit was generating income and using it for its exempt purpose, it wasn't taxable. Well, a really big case, we'll call it the spaghetti factory case. This was where a university received a spaghetti factory, and so it was pasta makers. They're making pasta, and the university is selling this to the general public, and they're wiping out competition. Those got a lot of publicity, and now you look at the origin of the revenue, not how the proceeds or the net revenue is used. So that's a really important factor. If we look at a trade or business, you think, okay, this is an activity that's producing income, and the intent, the motive is to result in a net profit. Intent is a really big factor here. If you're not operating with a profit motive or operating like a business that does that, it's most likely not a trade or business. But it can't be, you can't be thinking just because I have losses, I'm not running a trade or business. You could have a profit if you look at the cash position, like take out depreciation, charitable contributions. Are you running in a manner that a commercial activity would be doing? Are you trying to cut expenses to make future profits? Do you have a business plan? Do you have projections that are, maybe you're going to be in a loss position for 5 years, but you're expecting a profit year 6 going forward. So don't think just because you're at a loss, you don't have a trade or business. Okay. Okay, well, let me go back to trade or business too. I have an example I want to give you here. Say you are running an activity, you're a private operating foundation, you're a museum, and you have, you've decided, you know, we have that theater, let's open it up to the general public, and we're going to offer, when our museum's open, we're offering scientific type films. But hey, why don't we use it at night and offer Disney films to come in? This would be what you would call a dual use of an asset. So the scientific films that you're showing most likely are not going to be unrelated trade or business because it's going to be connected to your exempt purpose. But showing Disney films, if you're doing it regularly, you have an intent to make a profit, and it's not related to your exempt purpose, then that's going to be a trade or business portion of it that you would need to pay tax on. So regularly carried on. This is kind of an interesting slide, but it's not really defined. You look at frequency and continuity. It's not obvious, so what it does mean is not sporadic or infrequent. So you could have an activity that's done once a month, but it's done every month, once a month. And your competitors in the commercial world, they're also doing this once a month. So that leans more to regularly carried on. You want to look at how do for-profits do this? Is it just annual? What is the time connected to it before this annual event? Or is it really an activity that's done more than just 1 week? Is it months of activity? So here's an example. You could be a private foundation and you decide, hey, you know what? I think essential oils are great. The farmer market is open once a week. Let's go in there and sell some essential oils. It's going to be a really big hit. My friend makes it. She does all the bottling. We can get it at a discount. We'll make a great profit that we can grant out to our grantees. Doesn't that sound like a great idea? Well, that would be considered regular. If you're doing it regular once a week and you're with other commercial vendors that are selling once a week, it could be unrelated. You would also need to look at the other tests. Do you have an intent to make a profit? Is it related to your exempt purpose? We know it's frequent, regularly carried on. So you need to look at all the factors there. Most likely in that example, it probably is going to be unrelated business income. So now the last part of this three-pronged test is related, unrelated, or related. So you want to look at all the factors. Is this activity contributing importantly to your exempt purpose? Is it helping you further the exempt purpose of your organization? And there has to be a substantial causal relationship to achieve this. And I point out here you could have dual use of assets and facilities. The film museum example is a great example of that, where you could have two things going on at once, or not at the exact same time, but two things happening with those assets or facilities, where one is programmatic, it's related to your exempt purpose, the other one is not related, and that could pull it in. So some of the things that we look at when we're trying to determine if something is an unrelated trade or business income is we like to look at your organizational documents, your trust agreement, articles of incorporation, bylaws, your Form 1023. That's the form that you use to apply for exempt status with the Internal Revenue Service, and you laid out what your proposed activities would be. Also, we like to look at board actions and the Form 990, how they're reporting new activities, or the 990 PF, how they're reporting activities. On the 990 PF, if you do have a new activity, there's actually a question on the form at page 4, part 7A, line 2, that asks, has the foundation engaged in any activities that were not previously reported to the IRS? If yes, attach a detailed description of the activities. So this could be, maybe you've started a new programmatic activity that you want to tell the IRS about. It'd be a great place to do it. Or it could really be an unrelated trade or business activity that you'd want to disclose, yeah, we've taken this on. Your Form 990 PF is a public document. It's on GuideStar. And so you want to just be aware of how you explain about this new activity. And anyways, that is a requirement. So in the form. And it looks like we have our new polling question. Amy, passing to you.
All right, thank you. So our first polling question, If an NFP began a new revenue stream, which example below would be considered unrelated business income? A new revenue stream is substantially related to the exempt purpose of the NFP. B, the new revenue stream is considered a trade or business regularly carried on and not substantially related to the exempt status of the NFP. Or C, none of the responses above. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. And if you cannot see the submit button, please just enlarge the slide area so that you can view it. And we'll leave this up here another 5 seconds. Okay, here are the results.
Okay, great. The correct answer is B. That would be considered an unrelated business activity because it's a trade or business regularly carried on and not substantially related to the exempt purpose of the foundation. So, moving on. Exceptions and exclusions. So there's some statutory exceptions and exclusions from unrelated business income. And the first one is the volunteer exception, where substantially all the work is performed by people who are not being compensated. And this is the 85% or more. It's all done by volunteers. So if we think back to my farmer's market example, where the private foundation is selling essential oils, if that activity was conducted by volunteers, it would not reach the level of unrelated business income. The next example is the convenience exception, and this is really for the convenience of maybe members, students, patients, officers, employees, things like that. An example, this is kind of far-fetched, but I think you'll get what I'm trying to say. Let's say you run an animal shelter for elephants. I've been in Thailand and they do have those. They're very cool. So you have an elephant sanctuary and you are selling bananas to the people that come to look at the elephants. And you let the patrons that are coming in feed the elephants with these bananas. Well, selling of bananas is really for the convenience of the patron to enjoy the experience of feeding an elephant. So that most likely could fall under the convenience exception. A really common one is a bookstore selling books to students on campus. That's for the convenience of that student, or a cafeteria selling the student food. Another exception is the thrift shop exclusion, and this is where you're selling merchandise where substantially all of it has been donated to the organization. Exclusions from unrelated business income. This includes interest, dividends, royalties, and annuities. Those are your statutory ones that are excluded. However, if it's from a controlled group, or royalties have substantial services, that wouldn't be excluded. Also remember that in this category, debt financing of the asset that is generating this revenue will cause unrelated business income in most cases. Gains and loss from sales of property, but not inventory used in your trade or business, and not debt financed things. Real property without services, fixed fee arrangements, not debt financed. Qualified sponsorships are excluded if there's no expectation of a substantial return benefit. Qualified convention trade show activity, qualified public entertainment, and bingo games if they're legal and are not regularly carried on by for-profit organizations. I wanted to show a quick slide here on qualified sponsorships. I use this as a cheat sheet. So when you think of sponsorships, this would be maybe you're having an annual event and other organizations want to come in and sponsor this. There are certain things that will protect this revenue that you're receiving and not have it be unrelated business income, and which is really conversion to advertising is the easiest way to think about it. But you can acknowledge the sponsor, their logos, slogans, their locations, phone numbers, value-neutral descriptions, a product or service listing. It cannot include qualitative, comparative languages, indications of price savings, value, endorsements, or inducement to purchase or use products. All right. Reporting. Okay, so the Form 990T, this whole form, and Colleen's going to get into all the details and the technical aspects of it, but basically when nonprofit organizations and private foundations had unrelated business activity, sometimes it wasn't reported, or if it was reported, it continually showed losses. And they're like, well, why are you in a trade or business that's always incurring a loss? Are you allocating too much expenditures to that activity? How did you figure out your dual use of an asset? Well, I don't know if we really buy it. It's going to be these big losses. Well, in 2013, they did a college and university study, the IRS did, and they sent questionnaires to 400 institutions, and they conducted about 34 examinations. Well, they really decided, a lot's going on here. They needed to change it up. So they really revamped how we calculate unrelated business income, separate activities, all that good stuff. Out of their exams, about 90%, there was a 90% increase in unrelated business income, and over 180 adjustments, which were about 90 million, and the taxes, there were different categories, so they looked at everything, use of net operating losses, all sorts of things. So now we have this redesigned Form 990 that really started in 2018, but they've been fixing it every year. So for 2020, they've also redesigned this. They have a new Schedule A that's used to report your unrelated business activity. If you just have one unrelated business activity, you file one Schedule A. If you have multiple different activities, like maybe you have your films, your Disney films is one activity, and then you have your investments in partnerships as another activity, and they're allowed to be grouped together, you'd have two Schedule A's. So, that's all different. The due date for the Form 990T is the same due date as your 990PS, and it includes extensions. If you do owe taxes, you want to pay your taxes by May 15th of your calendar year organization. And be careful of estimated tax payments. This can catch a lot of clients off, or a lot of organizations off guard, because you do need to be signed up with the Internal Revenue Service on their electronic filing system, EFTPS, and you have to be registered with them before you can make a payment. So do it well ahead of the time. And your quarterly payments are going to be due 5/15, 6/15, 9/15, 12/15 if you are a calendar year foundation. Beginning in 2020, actually it's for tax years that begin after July of 2019, although software couldn't handle it and the IRS wasn't ready to accept it, but now they're saying, all right, all 2020 990T returns must be filed electronically. So that's a big change for this year. When we look at current law change impacts, there's been so much going on with COVID. One of the first bullet points is the Paycheck Protection Loan forgiveness. If you were fortunate enough to get a PPP loan and you got it forgiven, that is recorded as a contribution on your Form 990-PF, and it will not affect your Form 990-T. There's also a temporary allowance of 100% meals, and this, in general, if you have business meals that are allocated to your Form 990-T, the general rule is 50% of those business meals would be allowed as a deduction. Well, the Taxpayer Certainty and Disaster Relief Act amended Code Section 274 to provide for 100% deduction for years 2021 and 2022. And this was really to also help stimulate the restaurant sector of our nation, because they're having such a hard problem with COVID. So they were trying to say, all right, well, let 100% of this be allowed. Go eat at restaurants. Help that business. So that's a little carve out. There's also payroll tax credits that you might be taking advantage of. And how does this impact your 990-T? So if you're providing qualified sick or family leave under the Families First Coronavirus Response Act, the part of credit that would be allocable to the Form 990-T, you would report it. Credits allowed would be considered other income for the amount attributable to the 990-T on your applicable Schedule A. The other big credit that's out there, and if you don't know much about this, we definitely would love to talk to you about it, but it's the Employee Retention Tax Credit under the CARES Act. And under this credit, if you are taking advantage of it, you have qualified wages to get the credit. If those qualified wages are allocable to the 990-T, you can't deduct them there as well. So watch out for that one. When we think of a Form 990-PF and where does the unrelated business income go? Well, it doesn't go on it goes on the first page of the 990-PF, column A only. This is your book income, and it's going to include unrelated business income. But column B for the 990-PF, this is where you calculate your net investment income, which is subject to the 1.39% investment income tax. So you don't report unrelated business income in column B because it's going to be reported on the 990-T. And one of the tricky parts is, well, if your K-1 that you're getting from a partnership contains both elements, it's going to have net investment income and unrelated business income, then you need to make sure you're not paying tax twice, like reporting it in column B plus your 990-T. And that's something we really watch and review the K-1s very carefully for the 990-PF return. All right. The next slide, this slide is the 2020 990-T, and line 1 is where you're combining all of the income from the Schedule A's that are prepared. So the Schedule A is for each separate trade or business, and here we're adding up the taxable income. Line 4, they revised this to take the charitable contribution deduction at the aggregate level of all the allowable combinations of Schedule A. So that's nice. So now we can look at that. If you're formed as a corporation, it's limited to 10% of your unrelated business income. If you're a trust for 2020 and 2021, it's 100% deduction. Usually it's a 50% one, but this is an incentive through the CARES Act that's allowing for a higher deduction for trusts. And then line 6 is your net operating losses. Line 8, every organization gets a $1,000 exemption, and this number has not changed since 1950, by the way. They had no index for cost of living changes. It stayed that forever. And Part 3 is your tax computation. Page 2, you're looking at payments. Certain Information and other activities. They want to know, do you have foreign bank accounts? Have you changed your method of accounting? They have certain questions, and then you can provide additional information at the last part 5. Looking at the Schedule A, this used to be what the page 1 of the Form 990T looked like. It would want to know, it goes through the basic activities, the P&L. What was your income, all different categories for that, and then deductions at part 2 to come up with your totals. Pages 3 and 4, I didn't add those in, and those are may or may not apply, but those are looking at controlled group income that is subject to tax, exploited exempt activity income, advertising, and also reports officer board compensation related specific to that Schedule A. So whatever you've allocated, they want details on that. Okay, next polling question, Amy.
All right, thank you, Patty. So our second polling question is the 2020 Form 990T was modified to include which of the following? A, Schedule M is now required to report separate UBI activities. B, the 2020 Form 990T can generally be paper filed with the IRS. Or C, Schedule A is now required to report the UBI activity details, and multiple Schedule A's are required if there is more than one separate trade or business. And as a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, we'll leave this up a few more seconds. Okay, here are the results.
Okay, great. The correct response was C, that Schedule A is the new schedule that's attached to the 990T, and you have multiple ones if you have multiple trades or businesses. Okay, I'm going to pass the baton over to Colleen. Thank you.
Thanks, Patty. So with a lot of private foundations, where we see unrelated business income is in investments. So the investments, we can be looking at property, real estate property that's being rented out, or alternative investments. So with that, we just kind of wanted to dive deeper into that, dive deeper into how the different investment activities get classified under the new separation of unrelated business activities. So first we'll dive into unrelated debt financed income. As Patty mentioned earlier, rent of real estate and then most other investment income is generally excluded from being unrelated business income, but there are some exceptions to those exclusions, and one of those is income from debt financed property. So what is debt financed property? Well, that is property where indebtedness has been incurred to purchase or substantially improve property, or what is called acquisition indebtedness. Some common types are mortgages on real estate property or potentially margin debt on securities. And I think that's one thing most of the time when we're talking about debt financed property, most people are thinking about the rental of real estate. But if any of the securities, if there's margin debt, or if an organization has taken out loan or used debt proceeds to purchase those securities, these rules can also be applicable to that. But any debt that's incurred as a result of acquiring the property, that counts. It's something too that can get a little tricky is that it's not just debts where you've used the proceeds to directly purchase or substantially improve property. So if an organization uses their operating funds, they have excess operating funds, and they use that to purchase a property, but then shortly thereafter, they maybe need to draw from a line of credit that they have because they don't have enough funds for operation, the IRS is saying, no, that's essentially you took that debt out because of the purchase of that building. A part of it is to, make sure that there isn't potential debt financing avoidance where, well, I didn't use the debt to purchase the property. I used, cash that I had. Again, the IRS is going back and saying, you wouldn't have needed to take that debt out if you hadn't purchased or substantially improved that property. So debt-financed property taxable income, you'll often hear it referred to as unrelated debt-financed income or UDFI. UDFI is a lot easier to say than the whole debt-financed property taxable income. So just a heads up, if you're talking to your tax advisor, that's often how we'll refer to it. The calculation isn't as straightforward as a lot of other unrelated business income might be. It's not just total income less total related expenses. So what you're doing is you're starting with that. You're starting with the net income from that debt-financed property. But then you're only taking a portion of it. You're taking a portion of it that's related to the property, the portion of the property that is debt-financed. So to determine that ratio, you take your average acquisition indebtedness over your average adjusted basis of the property. The average acquisition indebtedness is computed on a monthly basis, where the adjusted basis average is computed on an annual basis. And it's limited to 100% of net income. So because the ratio is based on the adjusted basis, it's not related to the cost basis, there could be a point where, the amortization of the debt is going down slower than the depreciation of that. So your ratio could be a number that's higher than 1. Well, in that case, you're limited to 100% of net income. You're not having to pick up 150 or 200% of the net income that you have from that property. Also, the gain or loss from the sale of debt-financed property is also unrelated business income. This is applicable to property that has acquisition indebtedness on it, either at the time of sale, but it also is if there was indebtedness on it within the last 12 months prior to the sale. So you can't, okay, we're going to sell this property that has debt on it. Okay, we're going to pay off the debt because we know that that'll cause unrelated business income. And then a month later, we're going to sell it. We're good. There's no acquisition indebtedness on it. Well, that's not. And a strategy for that might be, well, short term we can pay this off, and then the proceeds we get from the sale will essentially help offset, the funds that we use to pay that off. Well, again, the IRS said, no, I don't think so. And so you do have to look at the prior 12 months from the sale date. If there's any acquisition indebtedness on it at that point, then it's still related. It's still subject to unrelated business income. Again, you're looking at an average, it's not the total. And for that 12-month period, you're looking at the highest debt amount outstanding within that 12 months, which likely could be the beginning of that 12-month period. So there are some exceptions to debt-financed or UDFI treatment. This is where unrelated business income gets fun because you have an exclusion to UBI, and then you have an exclusion to that exclusion, and then you have more exclusions. So the first one is if substantially all of the property's use is related to the organization's exempt purpose, to the exercise or performance of it, then it is not treated as unrelated business income. Of course, the IRS doesn't clearly define what substantially is. From other guidance, court cases, et cetera, it seems to be that about 85% or more is kind of what the IRS is looking at is to be considered substantially This could come into play with, maybe there's a museum that's a private operating foundation. You have the museum building, let's say it's got acquisition indebtedness on it, and a portion of it's rented out for a restaurant that's on site. So property's debt financed, there's rental on it, but if at least, if the building is substantially being used for the museum, which is that organization's exempt purpose, it qualifies for the exception of that rent being treated as UDFI. There's also what's called a neighborhood exception, that if the real property is acquired and the intent is that eventually it's going to be used for the exempt purpose within 10 years, that's another exception. And then if the property is used in an activity that's generally excluded from UBI, like Patty had covered earlier, that would be the volunteer, the convenience, or donated merchandise exceptions, then it's also excluded from UDFI. I will say most debt finance property that is held by private foundations is generally investment property. So outside of that museum example I provided earlier, most likely debt finance property held by private foundations is likely not going to qualify under one of these exceptions. Some other nuances with debt finance property, you may ask, well, what happens? Excuse me. So some of the other nuances with debt finance property, if property is donated that is subject to indebtedness, it is not debt financed for a property of up to 10 years after the donation. If the donation is by bequest, so like from an estate, it's 10 years. If it's by gift, then it's just 10 years. You do want to be careful with this donation of property subject to indebtedness. Generally with, non-operating private foundations, a lot of the donations are coming from a substantial contributor who is considered a disqualified person. When you have that, you are potentially running into self-dealing issues. We're not covering that in this. We will be coming out with an article that goes into self-dealing and what it is. But you want to avoid self-dealing because there's excise taxes involved, and then there's also the requirement of having to essentially unwind that donation of property. So property with debt that's being donated, you want to look into it, contact your advisor, make sure that this isn't going to cause self-dealing issues. Also, refinancing of the indebtedness, it's considered to be continuation of the old indebtedness, so it essentially keeps the same nature. However, if you increase the loan principal, it's treated as separate indebtedness. And that could be good because let's say you have your original loan and it's considered acquisition indebtedness. You used it or it's related to purchasing property or substantially improving it. And then when you go to refinance, you take out additional funds, but those funds you're using for operations or you're using those to purchase equipment that the organization is using. That additional indebtedness would not be considered acquisition indebtedness. And so you don't take that into factor, and you don't factor that in when you're calculating your UDFI. So for example, let's say an organization has an outstanding principal acquisition indebtedness of $500,000. It borrows another $100,000. That's not acquisition indebtedness. And essentially it, groups those two together. So it's just got one note with the lending institution of $600,000. So with that, you're going to need to separately track the $500,000 and the amortization schedule for that $500,000 and the separately from the amortization of that $100,000. If you've got it in one note, your amortization schedule is going to have that combined. So that's some additional detail and administrative work that you'll need to do to track them separately. Also, for depreciation of the property, it is required to be on a straight line method And then controlled rent is excluded from unrelated debt financed income. So you look at controlled rent first, and then after you pull that out, then you look at any remaining rent and the unrelated debt financed rules. And with that, we are on to our third polling question.
All right, thank you, Colleen. So our third question is, do debt funds have to be used to directly acquire or improve property for it to be acquisition indebtedness? A, yes. B, no. And I also would like to remind the audience that you can submit questions for the presenters using the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. All right, here are the results.
Thanks, Amy. So it is 50-50, and so this kind of goes back to, no, it doesn't have to be directly used. It goes back to that example of you can use cash to purchase a property, but then if that later requires you to take out a loan because you don't have enough operating cash, that loan can be attributed back to the purchase of that property, and it can be considered acquisition indebtedness. With that, we're going to move on to the separate reporting of unrelated business activities. So the Tax Cut and Jobs Act, passed in 2017, created a new IRS Code section, 512A6, which requires the separate reporting of unrelated business activities, and it is here to stay. So high level, if you have Activity A and Activity B, Activity A has a loss, Activity B has income. You can no longer take the loss on from A and the income from B and offset each other. They are separated. You'll hear this as siloing, you'll hear it as bucketing, which just kind of help give you a visual idea of how this gets treated. Now with this, there were final regulations that came out before the IRS had said it would be reasonable basis to separate activities out based on the NAICS code, which is by the 6-digit level. The final regulations that came out said that organizations could just utilize the first 2 digits of the NAICS code. The code that needs to be used represents the unrelated activity and not the organization's general exempt activity. Separate geographic areas, those can all be combined if they're all the same all the same activity. And here's one thing that's important that was in the final regs. Once the 2-digit NAICS code is chosen, you can change it, but you're going to have to disclose on your return why you changed it and why you believe it should be changed. And with that, you're kind of putting the IRS on notice. And if you changed it so that you can group it with other activities, especially if those other activities have losses, the IRS may take a closer look at the return and may challenge that change. There's no de minimis threshold for being subject to 512A6. So one of the things that came up with this is investment activities and how to group those. So in general, if you are invested in a partnership, the partner is considered to be conducting the activities of the partnership. So you would have to look at the partnership and what its business activities or unrelated business activity was. Well, this gets complicated when you have a partnership that's invested in other partnerships. And so you're now trying to find out information about 6 different partnerships, let's say. That's a lot of work, that's a lot of administrative burden, and a lot of organizations, especially private foundations, they invested in those partnerships for investment purposes. The whole point is just to take the funds, invest them, and get a good rate of return. With that, the IRS did provide guidance on what can be treated as investment income or investment activity and thus grouped together. So that includes qualifying partnership interest, which you'll see referred to as QPI, debt financed properties, and then qualifying SCorp interest. So all three of these can be grouped together and just treated as one investment activity. UBI from payments from controlled entities, those cannot be aggregated with investment activity. Those are consolidated based on the payer. So if you have two controlled entities that you have UBI from, you have to separate it by those two controlled entities. Also, non-qualified partnerships or S corporations, you have to break out. For the non-qualified partnerships, you're looking at the activity that the partnership is doing. For the S corp stands alone. So if you have two S corps that do the exact same activity, you can't group those together. The IRS has said in their regulations, they stand alone. So what is a QPI? A QPI is a partnership interest that where the exempt org doesn't significantly participate, where it is not a general partner, and then where it meets one of the following tests. The first test is called the de minimis test, and if the organization has less than 2% of profit, interest, and capital interest, then it meets this test, and it's considered a QPI. The percentage is based on an average of beginning of year and end of year. Aggregation with other orgs or disqualified persons is not required. That was a change with the final regulations. Next test is the significant participation test. This used to be called the control test. With this one, if less than 20% capital interest is held by the exempt org, any supporting orgs, any controlled organization, you do have to aggregate for any of those, and the exempt org does not significantly participate, then it can be a QPI. There's also the transition rule or the look-through rule. With a significant participation test, any of these three, it makes the exempt org considered to be significantly participating. So essentially, if the exempt org can require or prevent a partnership from doing a specific activity, if it has the power to appoint or remove officers, employees, majority of the directors, or it can significantly participate in the management of the partnership, considered to significantly participate, and that partnership doesn't qualify as a QPI. Transition rule, this was for certain investments that were held before 8/21/2018. You didn't have to essentially look through no matter what the percentage was, even if the percentage changed after August 21st, 18. This was applicable until the final regulations came out, which the final regs came out last December. As such, as of tax years beginning after that, so most organizations that have tax years beginning in 2021, this rule no longer applies. It does apply for 2020 though, so if we're still working on those returns, just know that it does still apply. And then the look-through rule, the easiest way to explain that is just to show it in an example diagram. So let's say that an organization has a 50% ownership in a partnership. It's not a QPI, you're over that 20%. And we're assuming that the transition rule does not apply. So then you have to look through it. So let's say you look through and it owns an investment in partnership A, and it has a 4%. So you look back to the exempt org, and through the LP, it owns 2%. 2% is the de minimis, and so it qualifies as a QPI. That can get treated as investment income. You look at partnership B, it has 10%. So for the exempt org, it's considered to have 5% because we're looking at 50% of what that ownership is. That's over the de minimis, but then you would look at the significant participation test. And then finally, partnership C, there's a 60% capital and profits interest. It's over the 2%, it's over the 20%, so it is not a QPI, and you need to aggregate, or you need to look at it, the business that it's performing, for determining how the activity should be treated. For qualifying SCorp interest, so the general rule is that SCorp interest is treated separately, and that there isn't any look-through required with an S corporation. It kind of gets similar to like a C corporation treatment, where you're not having to look through to see different investments that the S corp may have. And then you're generally basing that off of the K1 income that you're receiving. If you're selling the S corp interest, that sale, the gain or loss on that is also considered an unrelated business income, but it can get grouped with prior S corp income from the general operations. It can meet the de minimis test or the significant participation test, and if it does, then you can treat that S corp interest as investment activity and group it with other income that's considered to be investment activity. These are just the 2-digit NAICS codes. And with that, we'll go to our final polling question. Amy?
All right, thank you. So the last question is, which of the following is not considered an investment activity? And there's a few options, and then D is all of the above. So go ahead and make your selection and then hit submit. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. And we will also be sending them via email tomorrow along with a recording of this webcast. We'll leave this up a little bit longer so everyone gets CPE. And once you have completed all CPE requirements, you will be able to download a PDF of the certificate from the CPE progress window. And we'll also be sending it out in a few weeks if you have difficulty downloading it now. Okay, here are the results.
All right. So what's considered to not be investment? Well, income from a qualified partnership or S corporation, that is considered to be an investment activity. Rent from debt finance property, that is also considered to be an investment activity. Rent from a controlled organization is not considered to be an investment activity, and you're going to look at that as a separate activity from investments. Also, in general, for rent, that is the rent where there's the exclusion to rent not being UBI, such as, more than 50% of it is personal property, or it's personal property only that's being rented out, or services are being provided. The IRS has said that the NAICS code that should be used for that is real estate rental and leasing, which is code 53. And so finally, one other thing we just wanted to touch on is expense allocation. Treasury and the IRS are considering the allocation of expenses. They feel like this isn't necessarily being done appropriately. It's something that a lot of the IRS will look into a lot of times if they are doing an examination. They intend to publish a separate notice of proposed rulemaking for further guidance. They were going to try and include it in the separate UBI activity guidance, but ended up not doing that. So until they provide guidance, the current standard of any reasonable method stands. Of course, we don't have a clear definition necessarily of what that means. They did, however, say that gross to gross method, so you're allocating expenses based off of unrelated business income to total, is not reasonable. Although there could be an exception for that. Here's some commonly allocated expenses. And then for private foundations, most of the qualifying distributions that were made to meet that required minimum distribution, those can also be taken as charitable contributions on the 990T against unrelated business income. They are subject to limitations. For corps, it's subject to 10%. The increase to the 25% under the CARES Act does not apply to tax exemptors because it comes from different code sections, but then trusts do have a larger amount of contributions that they can deduct. And then net operating losses, pre-NOL losses can be, pre-2018 losses can be taken before using post-2017 NOLs. Pre-2018 NOLs are grouped post-2017 NOLs you have to use separately. There was a change to carrybacks from the CARES Act that changes that you can carry back the NOLs for a potential 5-year period. And with that, we unfortunately do not have time for questions and answers, but if you do have any, please put it in the Q&A box and we will be sure to follow up with you afterwards. And with that, I'm going to turn it back over to Amy.
All right, thank you. So yes, unfortunately, we are out of time, but thank you, Patty and Colleen, for a great presentation today. And thank you to our audience for submitting your questions. As Colleen mentioned, we will do our best to follow up with you afterwards. And we also have several resources available, so make sure you visit our website to check out all of these listed here. And finally, here is a link to an online survey for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again next time.